Euler Hermes is the world leader in credit insurance. Our job is to protect companies that have problems with their clients when it comes to getting paid. We operate in 60 countries and we have approximately 700 billions of exposure, which means that we insure almost 700 billion of intercompany credit. So globally in 2016, for the first time since the global crisis, insolvencies worldwide will increase by 2%. In Poland, insolvencies will continue to decrease this year by 3% compared to 9% decrease last year. This means that insolvencies will be above 700 per year, which is still above pre-crisis level. If I compare to Eastern European countries, I guess Poland is still a good country when it comes to the risk of non-payment. The only two problems that I see is first the volatility on the zloty, especially for exporters to Poland. And the second thing is the decline in the increase or the deceleration, let's say, in the profits of Polish companies. We've seen slight increase in past dues, so companies that are paying later than they were supposed to pay in Poland, plus 30% last year. And the average term of payment, the delays of payment in Poland are not reducing, they're stabilizing above 50 days. So yes, insolvencies are decreasing, whereas in Turkey they're increasing, in Russia they're increasing almost by 10%, but still we see that working capital, meaning the bottom of the balance sheet of Polish companies, is still a little bit risky this year. In 2016, global growth will be slightly below 2015. It's the sixth consecutive year that growth will be below 3%. There are 5 reasons to this. The first one is anemic flows. Trade flows, investment flow, capital flows are actually very disappointing. Second reason, a lot of money, very little liquidity that goes to the right place at the right time. Commodity prices is the third reason. I think in the beginning it was good for everybody to have low commodity prices. Now it starts to create a lot of stress for the steel and metal sector, for the energy sector, but also for a lot of these exporting countries. Fourth, public policies. Governments are actually not very supportive of the private sector these days. And last, the flops of global growth is surprises. Brexit, China, everything seems like a risk. And so I don't think it supports countries in their efforts to be competitive. And it certainly doesn't support companies in their effort to go global. When I talk to US companies, when I talk to German companies, they actually feel much safer home than going abroad. I think we live in a world where actually a lot of companies do see more of the risk when it comes to exports than the opportunities, which is the wrong thing in the long run, because exporting is importing innovation. But for this, they need to go prepared. That's why we offer credit insurance to exporters. That's why banks offer currency hedging products. That's why we all need to make sure that when a company tries to go out of the comfort zone, they need to be supported by the financial services. So the crisis in Russia was very interesting because it was not one crisis, but 4 crises. You first had the political and diplomatic crisis with Ukraine, but then came the oil prices and the ruble that really plummeted. Then came the sanctions, then came the policy problem. Getting a loan today in Russia costs you approximately 20% when you're a company. As a result, most of the countries that were dealing with Russia is one of the top 10 export partners for Poland. They had to find other routes somewhere else. So they had to go to Western Europe, they had to go to the southern part of Europe. And so this is what happened to most of the countries. For Germany, for example, the total cost of exports lost in Russia is approximately 30 billion over the past 2.5 years. For Poland, in euro terms, it's about 10 billion. If I look at what's happening today, Polish exporters are still losing money in Russia because of the high risk of non-payment, but also because of the reduced purchasing power of Russian companies and households. So it is affecting the export profile of the Polish companies and not the European companies, but they have learned to live without Russia. Most of the companies have found other outlets. And some other companies, they found ways to continue to export to Russia via other countries. I personally think that by 2017, we should see a decrease in the tension with Russia, and that would mean an additional export opportunity for Poland, because I think it would be easy for us to restore our commercial mix, as Russia is exiting a recession and still has a lot to offer to the world. And in terms of savings, there are still high reserves and savings on the households and on the company balance sheet. So I hope for a positive outcome by the end of this year. In the meantime, we've learned to do without Russia, and Russia has actually learned to do without the West. Brexit, the biggest risk is on the UK. It should cost approximately £30 billion in exports and £200 billion in investment that could actually fly out of the UK if they were to exit with no free trade agreements. For Poland, the cost for exporters is about €1 billion. For investment from Polish companies in the UK, it could be around also 1 billion. It's very limited. The biggest risk for Poland is remittances from Polish families that are living in the UK, as the pound will depreciate massively, almost by 20% if the UK exits. I do think that Europe can succeed without the UK. I'm not sure the UK will succeed without Europe. The bigger problem is if the UK exits, we will see more and more pressure on the Europe à la carte. And as you know, in Poland, it's a big debate today between sovereignty and Europe. And I guess, you know, the UK exiting will create a little bit more tension about the future of Europe. That would be the biggest risk. Economically speaking, I think it's still something we can manage. I don't think a banking crisis is really likely at this point. I think there is a lot of pressure on the profits that the banks are making from the spread on the interest rates. The fact that interest rates are very low doesn't give a positive contribution to the profitability of the financial actors. Of course, there are tensions. You know, in Poland there was a little bit of a pressure point with the appreciation of the Swiss franc and the mortgages that were denominated in Swiss franc for companies and households. So you have some of these risks for the second tier or third tier of banks. But I think to a certain extent, not only the regulators have increased their watchdog, but also, you know, when you look at the stress tests, you know, in the Italian banking sector, in the Spanish banking sector, most of the actors are actually passing the test. They're taking it and it's actually okay. In Italy, there could be the creation of this bad bank that would help also decrease the cost of financing and lending to some of the actors. But overall, I don't believe in a massive, you know, turmoil on this front, which is the financial sector. I think the financial sector is under stress because of this adverse environment, but I don't think there is the right recipe for a crisis. I'm more worried about the old industries, you know, again, the steel sector, machinery and equipment, those sectors where debt is high. There is no further support from credit. That's one of the reasons also why the ECB is actually targeting corporates in their new measures. But I'm not one of those doomsayers when it comes to the future of the financial sector in Europe. I actually think that we have a strong financial sector if I compare it with the other regions of the world. But it's true that it could be put to work more in terms of helping the real economy, because this is one of the biggest challenges we have today in Europe. You have a lot of fragmentation of the financing of the European economy, some places with a lot of liquidity, some other places with not so much liquidity, but the actors are healthy. Euler Hermes has been in Poland for years, for decades. We are extremely happy to be here. We almost have 300 to 400 staff here. We are the leader in the market, and we will continue to invest. It's not an easy market because there is a big pressure on the prices. It's a very soft market for us. We often think that our clients don't see the risk-price adequacy the same way we see it, but we're growing nicely. We're helping the market develop also. We're working with brokers, which have been actually quite a nice maturity signal for the Polish credit insurance market. We continue to invest in our people, we continue to invest in technology, and to a certain extent, we continue to believe in the business acumen of Polish companies, both domestically and for exporters.